Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Well, single commodity ETFs, they are here, finally. I don't know what took it so long to happen, but we have here one of the founders, or the founder, of Teucrium Asset Management, Sal Gilbertie. Thanks very much for being on the show. I appreciate it.
Pleasure to be here, Mike.
So single commodities have been in a boom for a number of years now. Many investors, small investors, institutions now embracing commodities as an asset class. But one thing we haven't seen until now are single commodity ETFs, a corn ETF, soybean ETF. Your company has created those vehicles, many of them very, very recent. Talk about what you have now and these new offerings that you have.
Well, we do. We have 6 single commodity exchange traded products, a crude oil fund, a natural gas fund, our flagship, which has been the corn fund, and we just recently listed soybeans, wheat, and sugar as single commodity funds. And the unique thing about this is, and the reason Teucrium was formed, is that commodities as an asset class really developed into the mainstream since, 2004, 2005. Right. More institutional and really sophisticated investors. As more and more investors come to the fore, as more and more people are taking control of their own financial destiny, they become asset allocators. They become traders of things that they may not have traded before. And what these ETPs do is bring access to those people directly into commodities without them needing a futures account.
Right. Before, they'd have to use futures if they wanted to trade corn or soybeans. And now, with the exception of, we know there's been gold, the GLD. You had USO for crude oil. There was a natural gas ETF. But the others were missing. But now we have corn, CORN, and we have the soybean contract. Why do you think well, for one, obviously, they don't have to use futures anymore, as you said. But do you think this will really take off to the extent that some of the larger commodity, the gold and the oil, has?
Well, I think everything's relative in respect to the commodities. We do believe that corn is the most pervasive commodity besides energy in the economy. That no one can go throughout the modern economy without interacting with some corn product all day long. So people are more and more gaining the realization that they must include corn in their portfolio. Many people are overweight precious metals and energies. They are learning that they need to overweight some of the ags, or would like to. And so as people begin to not only understand asset allocation models, and the fact that in most current asset allocation models of large funds and large well-known indexes, the energies and the ags, especially the big 4, corn, soybeans, wheat, and sugar, they're really a fairly significant allocation in people's portfolios. The other thing is there's supply uncertainty with agriculturals. They must be produced every year. We use almost every bit of the supply that's produced each year. So, you can't grow a crop in the winter. If there's a crop failure, the demand really doesn't abate that much. Demand in agricultural products is quite inelastic. People and animals continue eating. Right. Now it's being integrated into the food supply, and we're not yet at the point where the corn and ags are so integrated into the industrial economy that even a global economic slowdown, affects them that dramatically. It does temporarily, but it more affects, in our opinion, people's purchases. So you'll see purchases slow down as prices of everything kind of come down, but you really see a rebound quite often, especially in the agricultural commodities. Again, people like to eat, and their animals like to eat. And you
I certainly do.
Well,
I tell you that.
And so it's important to have those in your
Now, you've done something very unique with your ETFs. I mean, you've tried to eliminate or curtail a little bit of the influence of contango and backwardation that you have in some of the other commodity-related ETFs. How did you do that?
Well, we specifically, we're commodities professionals. That's where we come from. And there are many good tradable products out there that aren't Teucrium products, but they were by and large designed by bankers and financial professionals. They hold spot month. We don't hold the spot month. These are futures-based ETPs, and so when you buy them, you know what you're holding when you buy a Teucrium product. They're not an ETN. That's a big distinction. An ETN is a note. It's a debt obligation. They're not transparent. You really don't, you know what you're going to be marked against, but you're not sure what the underlying core holdings are. In an ETP, you know what your futures basket is. In a Teucrium ETP, it's defined. It's very transparent. Our holdings are published on the website every night, and what we did was design each specific fund around the commodity. So for instance, corn, it always holds second month futures, third month futures, and the December following third month. That's very important. December's a crop year month. That's the year the farmers are in. That's the one the traders are in. So if you have an investment time horizon that's longer term, say quarterly or yearly, like asset allocators have, if you buy a product that is weighted in the front month and an issue of contango or backwardation, for those viewers who don't know, that's basically a cost of carry. It's a price discrepancy, and so things change within your portfolio.
Which a lot of investors are not aware of that.
They're not aware of that. And so if you have a longer term time horizon, and by that, we mean more than a month probably, you really want to look at what's commonly called next generation funds. Teucrium is a leader in that space. And what we've done, again, is design these things around the commodity, each specific commodity. So we know how corn is grown. We know when it's grown, when it's harvested. We know when the professionals trade that. So if you have a one-year time horizon, for instance, in your pricing view and asset allocation portfolio, you want to be where the professionals are a year out. They're the only ones trading it. They're the most intelligent ones trading it. You want your portfolio to reflect whatever it is that they reflect.
Interesting. Does it now? All of these are listed on the New York Stock Exchange.
That's correct.
Does it concern you at all? Is it any sort of an indicator that you're seeing now? We're seeing a proliferation of these commodity vehicles. Does it say anything about the commodities market? Is it maybe overdone? Are a lot of unsophisticated people getting in right now? I mean, you as a trader, does it suggest anything to you?
Well, it suggests that people are finally realizing the importance of the commodities in a person's portfolio. Everybody uses stuff. I mean, that's pretty easy to understand. And so having that in your portfolio can sometimes be counter-cyclical. It can help with your portfolio's correlation to the stock market sometimes, not often, not always, but often. I think the proliferation of products has a lot to do with regulation of commodities is becoming tighter. The ETPs are very clear and simple and transparent, but an exchange-traded note, for example, is easier to list, and the banks are easy to rapidly put out these products. I think that investors need to be very selective, consult their advisors, do their research on these things, and that will allow them to make intelligent investment choices. They're all good products. They're all vetted by the regulators. I think the profundity of them, if you will, is simply due to the people can feel the popularity coming, and banks have a lot of things on their balance sheet they're trying to get off. So that's why
let's talk about the regulatory aspect for a second. I mean, Dodd-Frank, for example, the elimination or reduction in proprietary trading by large banks, is that going to hurt activity in this area?
Well, our belief is that it could. We believe it might hurt liquidity out the forward curve, things like that. These regulations, everyone wants stable, well-functioning markets, and so I don't think we can look askance at these regulations. I do think we try to determine their impact, and they may have some effect on reduced participation. And I might add that goes both ways. There might be some danger in that reduced participation actually increases volatility rather than decrease it. Time will tell.
Now, your corn contract, that's been out there for a while, right? I mean, the new ones.
It's about a year and a half old, yes.
Okay, the soybeans are relatively new.
Soybean, SOYB, sugar, the symbol's cane, C-A-N-E, and wheat, W-E-A-T, all on the New York Stock Exchange.
How are those doing?
Well, they're fine. They're designed exactly like corn. Corn was a tremendous success, is a tremendous success, so we anticipate the same degree of success. It takes a while to get an ETP going, but those that know ETPs are highly liquid. It doesn't matter what yesterday's trade volume was or the average trade volume. ETPs are arbitraged back into the underlying commodity. That's a very important point for investors. So if they're trading an exchange-traded product during the time when the commodities markets are open and it's a commodities-based exchange-traded product, their liquidity is extremely good. So the normal metrics that people use for securities aren't really relevant when looking at exchange-traded products. They're highly liquid and very easy to trade. Who
would be the typical investor? Is that like an individual investor? Do you have institutions using these instruments now?
We have institutions are slow to adapt. They have specific rules. Many of them have to wait for a certain amount of time.
Does there have to be a certain market cap for them to get
Some
involved?
of them, they all have different rules. And again, we're a very young firm.
Right.
And so it may not be so much institutions, although we are hearing from them. Some of them are actually waiving their rules just to participate in the corn fund because it gives them good access. But mostly registered investment advisors investment professionals, some individual investors. We don't sell shares directly to the public. No sponsor of an exchange-traded product actually sells to the public. So we actually sell our shares to broker-dealers who then disseminate those shares. So we don't really see the end user firsthand.
So let me just get your sense of the outlook for the commodity markets, let's say over the next 5 years. I would assume you're bullish. You launched this product. But how do you feel about the longer-term outlook?
Let me not go with bullish or bearish. That's for each individual investor to decide. And we provide products so they can exercise their vote on whether the price is going to go up and down and easily access them through an easily understood product. The next 5 to 10 years, it's why we formed Teucrium. There is no question that the rising global population, rising economic prosperity in third world countries, in the BRICS nations in particular, is bringing an incredible demand for all commodities. That's going to create stresses in the system that will provide opportunity for investors, and asset allocators are really looking, especially toward the agricultural space, to get in there, and they're looking for well-designed energy products. And Teucrium believes it's filled both niches pretty well.
It certainly looks like a great product. Sal Gilbertie, thanks very much. That's it for the show, folks. See you here next time. This is Mike Norman signing off. Bye-bye.